It's Monday, August 11th, and Wall Street is waking up to a cocktail of record highs, political drama, and a tech giant at the center of it all. NVIDIA's stock is still on fire, but can even a $4.5 trillion AI titan dodge a bullet when Trump's tariff game just went next level? Let's break it down. Welcome to another deep dive. Today, we're plunging into a fascinating intersection of technology, finance, and geopolitics. We've pulled together a stack of recent reports and analyses focusing on the current market landscape, NVIDIA's truly incredible performance, and the escalating U.S.-China tariff tensions that are really simmering right now.
And our mission today is to unpack these interconnected stories for you, providing the essential insights and those crucial aha moments you need to understand what's truly driving the headlines. And, maybe more importantly, what's potentially coming next. We'll meticulously examine the market's current, frankly surprising, momentum, dissect NVIDIA's recent and, honestly, astonishing deal, and explore the wide-ranging implications of that looming tariff deadline that could reshape global trade. We're going to connect the dots between market movements and policy shifts, helping you see the bigger picture and how these seemingly disparate events are, in fact, deeply intertwined.
Okay, so let's start with that bird's eye view of Wall Street. It's Monday, August 11th. U.S. stock futures are hovering near record highs. It really indicates a strong, almost, you could say, ebullient start to the week. Remember last Friday? The NASDAQ actually closed at a fresh record, which definitely contributed to this overall momentum.
Right, there's this sense of optimism.
Yeah, a palpable sense of optimism in the air right now. It feels almost like a continuation of the rally we've witnessed over the past few weeks. Like a quiet confidence that the market can just keep climbing. If you look at the charts, it's mostly green across the board, pushing up against and sometimes breaking through those all-time highs. Now, if you're invested in this market, this is certainly great news, right? It feels good seeing portfolio numbers climb, but, and there's almost always a but in these high-flying situations, it always begs the critical question, what's truly sustaining this rally? And maybe what underlying anxieties, what unseen pressures could potentially shake it up.
Yeah, what's the catch?
Exactly. It's almost as if the market is holding its breath, daring itself to go higher, while a few key data points are still out there, waiting to drop and potentially reshape everything.
And speaking of those key data points, the one everyone on Wall Street is watching with bated breath this week is the upcoming core CPI, the Consumer Price Index data. This report's due out shortly, and current estimates are showing core CPI rose about 3% year over year in July.
Okay, 3%.
Now, for those of you following the markets, you know why this is so crucial. CPI data gives us direct, immediate insights into inflation. Essentially, it tells us how quickly the prices of goods and services are changing for consumers like you and me.
Right, everyday costs.
Exactly. Think of your grocery bill, your rent payment, the cost of filling up your gas tank. CPI aggregates all those changes. And when we talk about core CPI, we're stripping out the often volatile food and energy prices. That gives us a clearer picture of the underlying inflation trends.
Got it.
This information, in turn, heavily influences the Federal Reserve's policy decisions. If core inflation is running hotter than expected, it signals that sticky, persistent price pressures are at play, which might compel the Fed to raise interest rates to cool down the economy.
Which markets generally don't love.
Generally not. Conversely, if it comes in lower, it might give the Fed more room to maintain a more accommodative stance, which tends to be very good for equities. So the implication here is massive. How might a higher than expected or lower than expected CPI reading impact investor confidence and these current market highs?
It's huge.
It's the kind of information that can send instant ripples across every sector, really dictating the market's direction for the rest of the week's trading. It truly is the elephant in the room this week.
Absolutely. It's a number that could make or break the week for many. But let's shift gears now from the macro economy to the tech titan that seems to be operating in its own universe. NVIDIA. I mean, with a staggering market capitalization of $4.5 trillion, NVIDIA isn't just a big player, it's practically a market in itself.
It's a behemoth.
Truly a behemoth dominating the landscape, a company that has redefined what's possible in chip manufacturing for this AI era.
Yeah.
And when we look at its performance, the numbers are just jaw-dropping. They almost defy gravity. In 2025, NVIDIA stock is up a whopping 36.1% year-to-date. To put that in perspective, that absolutely dwarfs the S&P 500's SPX 8.6% rise over the same period. I mean, we're talking about more than 4 times the returns of the broader market index. It's incredible.
It's a phenomenal separation.
And zooming in further, NVIDIA's outperformance is even more pronounced when you compare it to the iShares Semiconductor ETF, the SOXX. That's a basket of semiconductor companies. Over the past year, SOXX gained about 14%. Okay, respectable. But NVDA's gains just on a year-to-date basis outshine the ETF's 12.7% returns over that same time frame.
So even against its peers, it's pulling away.
Massively. It's like NVDA is running a marathon while everyone else is still, lacing up their shoes in the starting blocks. And crucially, they're not just running faster, they're setting the pace for the entire field, redefining what's possible in AI computing. Their growth trajectory is just phenomenal, seemingly unstoppable. You have to wonder what's fueling such a singular ascent.
Yeah, and what's truly striking here is that NVIDIA's dominance largely stems from its core business, especially its data center segment. They are, at their heart, the foundational innovators in computer graphics and AI technology, providing the graphics, compute, and networking solutions that are absolutely critical to the modern digital world.
The bedrock, really.
Exactly. Their data center segment is truly the driving force. It supports complex AI workloads for enterprise customers, particularly the hyperscalers. These aren't just big companies. Think Amazon Web Services, Microsoft Azure, Google Cloud. They operate at such an immense scale, running millions of servers globally, that their demand for chips like NVIDIA's basically dictates industry trends.
They're huge customers.
They're not just users, they're
Yeah.
effectively co-developers, pushing the boundaries of what these chips need to do.
Right.
And this isn't just about what they've accomplished. It's deeply tied to their future vision, which is incredibly compelling. Their next-gen platforms like Hopper 200, Blackwell, and the upcoming Vera Rubin. These are expected to solidify their position even further in the rapidly expanding AI computing market.
So they're not slowing down.
Not at all. What truly stands out is how these platforms are meticulously designed to push the very boundaries of AI processing, directly impacting the speed, capability, and efficiency of AI development globally. They are building the fundamental infrastructure that everyone else will build upon, ensuring their continued relevance and leadership in what is arguably the most transformative technology of our time. It's a long-term play on the future of intelligence itself.
So with all that incredible performance and an undeniable future vision, what do the experts on Wall Street actually think? How are the analysts looking at this?
Well, the consensus among the 45 analysts covering NVDA stock is a resounding strong buy.
That's pretty clear. Yeah, it's quite overwhelming. That's based on 38 strong buy ratings, 2 moderate buys, 4 holds, and only 1 lone strong sell. That kind of overwhelming consensus is incredibly rare for a company of this size and valuation. It suggests a near unanimous belief in its continued trajectory.
Right. You don't often see that kind of agreement on Wall Street for such a high flyer.
Exactly. Now let's talk about their Q1 results. They reported back on May 28th. While its adjusted EPS of 81 cents fell slightly short of Wall Street's expectations of 85 cents, so a small miss there, the company's revenue was a staggering $44.1 billion, actually beating forecasts of $42.9 billion.
So a beat on the top line, miss on the bottom line.
Right. Their earnings surprise history is a bit mixed. They beat consensus in 3 of the last 4 quarters, missing on that one occasion. But for the current fiscal year, which ends in January 2026, analysts still expect diluted EPS to grow a whopping 37.2% to $4.02.
Still predicting strong growth then.
Absolutely. It's like a star athlete who misses a free throw but still dominates the game with their overall performance, right? Scores 50 points, carries the team. The market seems to be more focused on that massive revenue growth and the undeniable future potential of their AI chips, rather than a slight earnings per share miss. Is it simply that in a hypergrowth sector like AI, revenue is just a stronger leading indicator than a minor EPS miss, suggesting investor confidence in future scale-up even if current profitability isn't perfectly aligned?
I think that's precisely it. Investors often look at high-growth tech companies through a lens of market share and future potential. A small earnings miss, especially if it's maybe due to strategic reinvestment or aggressive spending on R&D to maintain their lead, that can be overlooked if the top-line revenue growth signals undeniable product demand and a dominant position in an exploding market.
It's about the long game.
It's a fundamental bet on the future addressable market for AI, which NVIDIA is just uniquely positioned to capture. They're investing for tomorrow's immense demand. And the market is largely forgiving of minor short-term profitability fluctuations if the long-term growth story remains intact and compelling. This is a company not just riding a wave, but actively creating the tsunami of AI development.
Okay, creating the tsunami. I like that. Now, Here's where it gets really interesting and, frankly, a bit unprecedented. We've discussed NVIDIA's market dominance, its seemingly unstoppable growth. But the elephant in the room isn't just CPI anymore. It's this unprecedented political maneuver unfolding right at NVIDIA's doorstep.
The China deal.
Exactly. NVIDIA and Advanced Micro Devices, AMD, have reportedly agreed to give the U.S. government 15% of their revenue from AI-related chip sales in China. This isn't just a small concession. It's a significant chunk of revenue taken right off the top.
15%.
We're talking about specific chips here, like NVIDIA's H20 AI accelerator and AMD's MI308 chips. These are the ones the Trump administration had previously targeted with stringent export controls. It essentially means that for these critical AI components, a slice of every single sale in China goes directly to the U.S. Treasury.
Wow.
The New York Times reported that NVIDIA CEO Jensen Huang himself agreed to this arrangement at a private meeting with President Trump just last Wednesday. And quite remarkably, export licenses for these chip sales followed just 2 days later on Friday.
That's a quick turnaround.
Very quick. This essentially makes the federal government a direct partner in NVIDIA's business in China. It really blurs the lines between private enterprise and state policy in a way we haven't quite seen before. When I first saw this detail about NVIDIA sharing revenue, my jaw honestly dropped. It's one thing to have tariffs, another to have a direct slice of a private company's sales going to the government. Is this truly a new paradigm? Are there any historical parallels?
Well, what's truly unprecedented here is indeed the sheer novelty of this arrangement. Stephen Olson, a former U.S. trade negotiator, didn't mince words. He called it unusual or unprecedented, and even said that was a staggering understatement.
A staggering understatement. Wow.
Yeah. He suggested, and this is a profound observation, that we're witnessing the monetization of U.S. trade policy, where companies are effectively paying the U.S. government for export permission.
Paying for permission.
Think about that for a moment. It's not a fine, it's not an import tariff, it's a direct revenue share on exports. This isn't just a new tax. It fundamentally redefines the government's role in global business. Imagine other sectors where this model could apply. What about pharmaceuticals, clean energy tech, maybe even data services?
It opens a Pandora's box.
It could dramatically shift global supply chains from being solely efficiency-driven to becoming politically compliant, forcing companies to make strategic choices not just on profit, but on geopolitical alignment.
Okay, the implications of this are just immense.
They really are. This could set a new and potentially dangerous playbook in U.S.-China tech relations, raising fundamental questions about future trade negotiations and the very role of government in private enterprise, especially in strategic sectors like AI. If we connect this to the bigger picture, it underscores the administration's stated focus on maintaining America's AI tech stack as the world standard, and, crucially, avoiding a repeat of the 5G telecommunication leadership loss, where many believe the U.S. fell behind.
Right, they want to avoid that happening again with AI.
Exactly. It's a clear signal that they're willing to take aggressive and unconventional steps to protect that technological advantage, even if it means creating entirely new mechanisms for trade. So if companies are essentially paying to play, does this open the door for smaller companies or developing nations to be unfairly disadvantaged? Or does it create a new form of soft power where economic leverage becomes a direct revenue stream for governments? It raises so many questions about fairness and market access.
And you have to imagine China isn't exactly thrilled about this.
Oh, absolutely not. Beijing is highly unlikely to warm to this chip tax. We've already seen early signs of their displeasure, suggesting a growing resentment. The social media account Yunnan, which is affiliated with state-run China's Central Television and often signals Beijing's thinking on trade and policy, they've already slammed the H20 chip's supposed security vulnerabilities and inefficiency.
Already pushing back.
Yeah, this isn't just a minor complaint. It suggests a narrative being carefully constructed around these chips, potentially aimed at discouraging their adoption within China, especially as local firms might be pressured to prioritize domestic alternatives. This raises an important question. How will Beijing respond to this perceived chip tax and its potential implications for their own national AI development strategy?
Right, what's their next move?
Will they retaliate with their own measures? Perhaps by accelerating domestic chip production, placing restrictions on foreign tech, or even encouraging domestic companies to simply wait for fully Chinese-developed alternatives. It adds another complex and potentially volatile layer of tension to an already incredibly intricate and high-stakes relationship between the two global superpowers.
Okay, as if the chip deal wasn't enough to digest, there's another critical deadline looming. It's acting like a giant clock, counting down over Wall Street, casting a long shadow over the market's current optimism. That deadline is Tuesday, August 12th, tomorrow.
French shot.
That's when the US and China either need to extend their trade truce or a whole new wave of tariffs will automatically kick in. This current truce, which has provided a temporary pause in the escalating trade war, was initially put on pause for 90 days back in May. So we're right up against it. The outcome of these negotiations, or frankly, the lack thereof, could send shockwaves across global markets, affecting everything from commodity prices to consumer goods, from the price of your next smartphone to the cost of your morning coffee. It's a real make-or-break moment for the trade relationship.
Definitely. Investors are holding their breath, waiting for a definitive signal. And leading into this deadline, President Trump has been publicly pushing for China to quadruple its soybean purchases from the U.S.
Quadruple? That sounds ambitious.
Okay, significant and quite ambitious demand, especially given China is the world's largest soybean buyer. Historically, only about a quarter of their usual purchases come from the U.S., with most of the rest sourced from Brazil. Experts like Johnny Shang of Beijing-based Igradar Consulting believe this is highly unlikely, bordering on the impossible.
Impossible, okay.
It would require China to import the vast majority of its soybeans from the U.S., a truly significant and economically unfeasible shift for them, given their diverse global supply chains. It's an almost impossible ask, designed perhaps more for political leverage than practical implementation.
Makes sense.
What we're also seeing is how the administration's continued imposition of sweeping reciprocal tariffs has reverberated globally. These aren't just theoretical trade policy moves. They are starting to hit businesses across various sectors in very real, tangible ways, impacting their bottom line and forcing them to reevaluate supply chains, pricing strategies, and even their core business models.
And that impact is certainly being felt by some of the biggest names and industries around the world. Let's get into the nitty-gritty of who's feeling the squeeze.
Okay, well, starting with automotive and manufacturing. Many companies rely heavily on imported components, which are now significantly more expensive due to these tariffs. For instance, Ford expects tariffs to knock a staggering $2 billion off its earnings this year.
$2 billion. Ouch.
That's not just a number. That means reevaluating sourcing, potentially delaying investments, or even passing costs on to consumers. Imagine if you're buying a new F-150. A significant portion of that cost could now be attributed to tariff-induced expenses on components like steel or aluminum.
Right. It hits the consumer eventually.
Often does. Caterpillar, the heavy equipment giant, anticipates at least a $1.3 billion hit. And Kimberly-Clark, known for consumer products like Kleenex, could see losses around $170 million. Germany's VDA Auto Association, representing major players like BMW and GM who have substantial U.S. operations, their supply chains are deeply integrated into the American economy.
Right.
They're urging the EU and U.S. to implement a promised trade agreement now.
They want that deal finalized.
Desperately. They point out that sectoral tariffs of 27.5% remain a significant burden on German automakers and their suppliers, making their products less competitive and severely squeezing profit margins at a time when the global auto industry is already navigating huge shifts like electrification.
It's a crushing weight on these global giants. And it's not just the industrial players feeling the squeeze. Surprisingly, luxury goods and precision industries, particularly in Switzerland, have been hit incredibly hard by what many there describe as a disproportionate impact.
That's right. Switzerland, a nation that prides itself on precision engineering, quality, luxury, they were unexpectedly slapped with a devastating 39% tariff, more than double the EU rate, despite initial hopes of avoiding them. Caught them completely off guard.
39%, wow.
Take Dubois Eiffel, for example, a 240-year-old watchmaker. They had a chaotic week, rushing to ship watches before that 39% tariff took effect. They ultimately had to block U.S. orders on their website because the price shock was immediate and unmanageable for customers.
Had to just stop selling to the U.S. online.
Exactly. Their CEO is now planning significant price hikes. For example, their Dubois DBF008 watch is likely jumping from around $10,800 to an eye-watering $14,500 just to absorb the tariff cost and maintain profitability.
That's a huge jump for a luxury item.
It is. And the U.S. accounts for 17% of Switzerland's watch exports. So the wider industry, from Rolex to Patek Philippe, is feeling the pinch. Companies are pausing U.S. orders, actively seeking alternative markets, fundamentally reshaping their global distribution strategies. It's a profound disruption to a deeply established, highly specialized industry that thrives on predictability.
And it's not just watches, right? Even the meticulously crafted Swiss aircraft industry is finding itself grounded by this.
Indeed, Swiss aircraft manufacturer Pilatus temporarily stopped deliveries of its PC-12 and PC-24 business jets to the U.S., a market that, incredibly, accounts for 40% of their annual production.
40%.
Yeah. They're now considering allocating these high-value aircraft to other, less tariff-burdened markets, which represents a significant strategic shift away from their primary buyer. And then, in a truly surprising move that sent ripples through a very stable market, U.S. Customs and Border Protection ruled that 1 kilogram and a 100-ounce gold bars are now subject to tariffs.
Gold bars.
Seriously. Contradicting earlier expectations and unleashing immediate turmoil in the global bullion market. This has huge implications for Switzerland, a major gold refining hub, as well as other refining centers worldwide. It raises serious questions about legality and potential challenges from traders who expected these items to be exempt. This isn't just about the tariff itself, it's about the erosion of predictability in global trade, forcing a reevaluation of fundamental market assumptions for something as historically stable and liquid as gold.
I even saw a report that Swiss political figures are calling on FIFA's Gianni Infantino, the head of soccer's governing body, to help sway President Trump on tariffs. I mean, how desperate do you have to be to call on a soccer executive for trade negotiations?
Yeah, talk about desperate measures.
It really underlines the unprecedented nature of this situation, doesn't it? It just shows you how desperate some of these industries are becoming, looking for any avenue to appeal.
It truly does. And it speaks to the global entanglement of these policies. When trade barriers start impacting everything from luxury watches to business jets and even the beloved sport of football, you know the stakes are incredibly high. And companies are grasping at any straw to protect their interests. And the ripple effect extends even to agriculture, which is ironic given farmers are largely strong Trump supporters.
Right, that's a core constituency.
Exactly. They are seeing their profits squeezed as tariffs are raising costs for essential inputs like machinery and fertilizers. Agricultural giants like Mosaic Co., AG Seocor, and Bunge Global SA are reporting plunging deliveries of key nutrients and climbing machinery prices. This comes at a particularly difficult time, as corn, soybean, and wheat prices are at low levels due to ample global supplies, significantly cutting into farm revenues already strained by weather and market dynamics.
So low prices for their crops, high prices for their inputs.
It's a tough squeeze. For instance, fertilizer imports into the U.S. and Canada have been delayed or even cut, leading to what one company described as incredibly low inventory that desperately needs to be rebuilt before planting season. It's a double whammy for a sector already facing low commodity prices, forcing farmers to make tough decisions about planting and investment.
And these tariffs are having much broader economic and geopolitical ripple effects too, right? It's not just specific sectors, it's shaking up the global landscape.
Absolutely. From a macro perspective, Commerce Secretary Howard Lutnick expects a staggering $50 billion a month from tariff revenue as higher duties take effect, including new levies on semiconductors and pharmaceuticals. This points to a massive influx of revenue the administration is anticipating.
$50 billion a month.
Yeah, but it's revenue that comes directly from American businesses and consumers ultimately. However, this is also facing significant challenges. President Trump has publicly warned that a court ruling against his tariff authority, particularly under the International Emergency Economic Powers Act, or IEEP, could have devastating economic impacts, comparing it dramatically to 1929 all over again, a Great Depression.
Okay, maybe a bit hyperbolic, but the legal challenge is real. Explain IEPA quickly.
Sure. IEP is a powerful but controversial law. It grants the president broad authority to regulate international commerce during a declared national emergency. This is what the Trump administration has used to justify many of these tariffs, but critics argue its application here goes way beyond its original intent, leading to significant legal challenges. A court ruling against it wouldn't just stop future tariffs, it could potentially force the government to refund billions, maybe even trillions in collected duties.
Trillions, wow.
Which would be an unprecedented fiscal shock to the U.S. Treasury and the broader economy.
Okay, so high stakes legally too.
Very high. We're also seeing clear geopolitical shifts as nations scramble to adapt. Canada, for example, is actively working to reset ties with Mexico as both prepare for the potential fallout from U.S. tariffs. This is happening ahead of a North American Free Trade Pact review.
So North America is recalibrating internally.
It looks like it. We're seeing a tariff domino effect in North America. Canada, feeling the sting of U.S. tariffs and sensing a potential shift in U.S. trade priorities, is actively engaging with Mexico. This could involve exploring new bilateral trade agreements or strengthening existing supply chain integrations to build a more resilient North American economic bloc, less vulnerable to unilateral U.S. policy shifts. Trump hiked tariffs to 35% on Canadian goods not complying with the FTA, partly due to Canadian retaliation against his earlier levies. Mexico, interestingly, got a 90-day reprieve on new tariffs, perhaps reflecting a different negotiating strategy or relationship.
Interesting dynamics there. And what about India and China with Russian oil?
Right. Trump also warned both China and India about buying Russian oil. He followed through by slapping an additional 25% tariff on India, bringing its total to a hefty 50%. India's state refiners have now started to pull back on Russian oil purchases, waiting for clearer government guidance.
So the pressure worked on India, it seems.
To some extent, yes. China, however, has firmly defended its legitimate and lawful purchases of Russian oil, pushing back directly against Trump's threats and demonstrating a different approach to navigating these geopolitical pressures.
And then you have companies like Apple trying to play the long game, right? Navigating these shifting sands by making strategic domestic investments.
Exactly. Apple CEO Tim Cook has seemingly tried to stay in Trump's good graces by significantly expanding their U.S. investment commitment, now up to $600 billion over 4 years, which is up from the $500 billion pledged after Trump's second-term victory.
$600 billion, that's a massive number.
It is. A centerpiece of this expansion is a $2.5 billion investment in Corning Inc. for U.S. manufacturing of iPhone and Apple Watch cover glass. Trump himself touted this as Apple coming home, framing it as a success for his policies and a clear sign of manufacturing jobs returning to American soil. This reflects a clear strategic move by Apple to navigate tariff threats and foster a more favorable relationship with the administration by bolstering domestic manufacturing, showcasing their commitment to the U.S. economy. It's a high-stakes balancing act between maintaining global supply chains and responding to increasingly nationalistic economic policies.
A very delicate dance for these global companies.
Definitely. So after diving into all these interconnected layers, the market highs, the unprecedented deals, the looming tariff deadlines, what does all this mean for your portfolio, especially in the short term?
Yeah, the bottom line for investors.
Well, there's undeniably a high volatility risk, particularly for stocks like NVIDIA, AMD, and the broader semiconductor sector. The headlines around tariffs, these unique revenue-sharing agreements, the trade deals, they can cause rapid, unpredictable shifts in stock prices. For investors, this means staying incredibly agile and informed, ready to react to new information. This isn't really a market for the faint of heart or for those who don't follow the news closely. It demands constant vigilance and a deep understanding of these geopolitical currents.
Okay, so short term, buckle up for volatility. What about looking beyond the immediate headlines,
Right.
the longer-term implications? There seem to be significant long-term implications here, offering both challenges and potential opportunities. The U.S.-China chip tension, while certainly creating short-term headwinds and uncertainty for companies like NVIDIA and AMD, it could paradoxically strengthen domestic AI supply chains in the U.S. The administration's intense focus on America's AI tech stack, aiming for it to be the world's standard, suggests a deliberate push for greater self-sufficiency and resilience in critical technology sectors, kind of insulating the nation from potential supply disruptions or geopolitical leverage.
That's the potential upside, domestically.
But there's a clear trade-off, isn't there? This push for domestic strength for all its strategic benefits. It may well pressure overseas revenue growth for companies like NVIDIA and AMD. They rely heavily on global markets, particularly China, for a substantial portion of their sales. It's a delicate balance between national security objectives and the realities of global market access and revenue generation.
Absolutely. It's a huge strategic tightrope they have to walk. So as you navigate the markets this week, keep a very close eye on 3 key things for your watch list. First, that core CPI data release. It's going to be a major market mover and could signal the Fed's next moves.
Okay, CPI first.
Second, pay close attention to developments around the U.S.-China tariff deadline tomorrow, Tuesday. Any expansion or the implementation of new tariffs will have immediate and widespread impacts across various sectors.
Got it. The tariff deadline.
And finally, watch the overall reaction of the tech sector, especially semiconductors, to any policy announcements or official statements coming out of Washington or Beijing. These factors are all deeply intertwined and will largely dictate the market's direction, volatility, and potential opportunities as the week unfolds.
It really feels like this week isn't just about earnings or charts. It's about how politics, policy, and raw power plays collide in the markets, shaping fortunes and futures. Monday's firing, and the sparks are just starting to fly.
And considering the unprecedented nature of that NVIDIA-AMD deal, where the U.S. government is taking a direct cut of sales revenue from private companies, and the ongoing escalating tariff battles. What does this new era of monetized trade policy truly mean? What does it mean for global businesses and the fundamental principles of free trade? It raises a crucial question for all of us. How will governments balance vital national security interests with the undeniable reality of global economic interdependence in the years to come?
A huge question indeed. Keep exploring, keep questioning, and join us next time for another deep dive into the stories shaping our world.